Take a look at this chart. It shows us the average US 30-year mortgage interest rate. Back in 2019, this rate was between 3.5 and 3.75%. Then when the pandemic happened, this rate fell sharply, bottoming out at 2.65% in January of 2021. All through 2021, the average 30-year mortgage interest rate danced at below or around the 3% mark. Then 2022 came around and everything changed. What's up everybody, it's Prashant here. Welcome to my YouTube channel and thank you for joining me today. As you may know, I recently bought a house in Washington State and not a moment too soon because interest rates are on the rise. In fact, I myself got hurt by these rising interest rates because I got into a 30-year fixed rate mortgage at 4.25% interest rate. Honestly, it hurt a lot to sign that contract because I know that just a year ago, mortgage interest rates were about 3%. But this is the time we had to buy and this is the rate we got, so that's that. Today I'm here to talk about exactly what's going on in the housing market, including why interest rates are rising so quickly, why housing prices are so high, what the best way is to buy a house in today's market, and even if it is the correct time to buy a house today. So this is a lot to talk about. Let's dive in right after you smash the like button and subscribe to this channel. Thanks for doing that and let's go. About 3 weeks ago, in the first week of April, the average mortgage interest rate on the 30-year mortgage topped 5%. This is the first time this has happened since February of 2011, and they continue to go up. Now, I'm going to tell you exactly why this is so significant in a minute here, because sometimes it is not very straightforward and easy to wrap your head around. Let's say you wanted to buy a house that's listed for $400,000. Now, if you were putting 5% down, which is $20,000, you have to borrow $380,000. Now, last year in 2021, when interest rates were about 3%, you would have to make a mortgage payment of $1,600 for just principal and interest. Maintenance, taxes, all those other things are on top of that. Let's ignore that for a bit. So $1,600 would have been your payment if you got that loan for 3%, which is what it was in 2021. Now today, if you had to get that same loan at a 5% interest rate, your payment is $2,040. Basically, $400 more for the exact same house every single month. Incidentally, the average grocery bill of the average US household is about $400 a month. My car payment is $400 a month. So this increase in interest rates is eating into our household budgets in a very, very significant and definite manner. Let me explain this to you in another way. Say your monthly budget for a mortgage was $1,600. Back when the interest rate was 3%, based on a 5% down payment of $20,000, you could afford a house of $400,000. Now today, with the same $1,600 a month budget and the same 5% down payment, you can afford a house that's only $315,000. And if you've been keeping up at all with the housing market, you know that the pricing of houses has gone up ridiculously over the last year or two. So you're getting a lot less house for your money to begin with. So prospective home buyers are being squeezed on both ends. On the one end, housing prices are rising, and on the other side, interest rates are rising, so the cost of borrowing is rising. What this basically means is that people have to settle with us. So prospective home buyers are being squeezed at both ends. On the one end, housing prices are increasing, and on the other end, interest rates are rising, which means cost of borrowing is rising or your mortgage payment is rising. So what this basically means is that people are able to afford less house than they actually need, have to make cuts in other areas of their life, or maybe they're being priced out of buying a house entirely. First, let us talk about why interest rates are rising so quickly. 30-year mortgage rates generally track the 10-year bond yield. As the 10-year bond yield increases, so does the interest rate on the 30-year mortgage. Take a look at these graphs. On the top is the 10-year treasury yield going back to 2007, and on the bottom is the average 30-year mortgage interest rate also going back to 2007. What I want you to see is how identical the shape of these graphs are. They basically move in lockstep. As one goes up, so does the other one. Now let's focus on what happened in March of 2020. When the pandemic first started and we had the lockdown, investors were terrified and they sold a bunch of their stock and they were flocking to US treasuries or US bonds. Now, when a lot of people want to lend the government money, the government pays lower interest rates, which is basically another way of saying that the yield on the US 10-year bond goes down. So right after the 10-year yield collapsed, so did mortgage rates, bottoming out at just 2.65% in January of 2021. Now though, the 10-year treasury yield is climbing higher, and so are mortgage rates. So right now inflation is super high, so investors are demanding higher and higher returns, and that's why treasury yields are climbing. So let's take a look at this. Right now, treasury yields are going back up to nearly the December 2018 levels, roughly 2.8%. So let's look at what mortgage rates were doing back in December of 2018. About 5% or 4.75%, pretty close to our today's rates of 5%. So, can mortgage rates climb any higher? Sure they can. Now, over the last 2 or so years, we've gotten used to the sub 3% interest rates, but that's not the norm. In fact, if you look at this graph, just take a look. Between 2009 and 2020, mortgage rates were about 4.5 to 5%. So, can mortgage rates go any higher? Sure they can. The thing is, over the last 2 years, we've been spoiled with these sub 3% interest rates, but that's definitely not the norm. Just take a look at this graph. Before this recession that we had recently, from 2009 to 2020, interest rates generally hung around 3.5% to 5%. And before the Great Recession, from 2001 to 2009, they were between 5.5 and 7%. So for sure, higher interest rates are definitely possible and may even be likely at this point. That being said, let us now talk about why housing prices have been so high lately. There are a few different reasons, but there is one overarching theme, and that is that there are far fewer houses out there in the market than we need right now. Take a look at this graph by the Federal Reserve. You can clearly see that the number of buyers in the market, which is shown in red, is far higher than the inventory or the number of houses available for sale in the market. And this has been a theme that we've been seeing for a long time. Basic economics take hold. Low supply and high demand mean prices go up. And this is something that we've seen for a few months now. People keep paying more and more for the same houses. In fact, I myself had to take part in some brutal bidding wars before I was able to buy this house. But that's a story for another time. If we dig a little bit deeper into why the supply of houses is so low right now, two big reasons come to mind. The first one is that builders are just not building enough new houses, especially the entry-level 2,000 square feet, 3 to 4 bedroom category of houses. Why? Well, the first thing is that most of our big metropolitan areas are pretty well built up. So now people have to build suburbs further and further out from city centers. And our local governments have not been keeping up with zoning and rezoning properly to allow for more houses to be built up in their local jurisdictions. On top of this, commodity prices are really high right now. Labor prices are really high right now. So the cost of building houses is really high. So it might be more profitable for builders to build communities which are more like multifamily type housing, apartment type housing, because it's easier to run amenities like roads, fire, water, sewer to it, which makes sense, right? So some areas are seeing more growth in that multifamily apartment complex style situations, but not so much in the entry-level single-family home area, especially because builders can focus on the luxury top end of those single-family homes and make much more profit because they are a premium product, the buyers are not that price sensitive, and they can charge a premium for that type of a house. So a lot of builders, in my mind, are going to pivot to that premium end of housing, which leaves the single family home buyer, the entry level home buyer, in kind of a bind with lower supply. The second reason that I can think of behind this low inventory is the historic low interest rates that we saw in 2021. Back in 2021, a lot of people refinanced their existing mortgages to get into fixed 30-year long 3% interest mortgages. And now, if they want to sell that house to size up, size down, move across the country or whatever, they would have to buy another house and pay more than 5% interest on that particular mortgage. So their cost of owning a home, even if it's a comparable home, will be much higher than it is right now. So a lot of people would prefer to just sit tight in their current homes instead of putting that into the market, which on aggregate, I believe is lowering the supply of existing homes on the market. So the very same interest rates that helped buyers buy and refinance their houses back in 2021 are coming back around to haunt us and hurt the new buyers in the market right now. Okay, so now let's talk about what I think is going to happen in the housing market in the next few months, whether it's the right time to buy a house right now, and if you wanted to buy a house right now, what is the best way to do it? See, obviously the answer to the question, or at least the last two questions, depends on your personal situation. But here's what I think will happen with the housing market in the next few months and over up to a year. I believe that over the next few months, we are going to see continuing rise in mortgage rates. I think we're going to see 6% or maybe even 7% interest rates in the near future. Now, obviously, this hurts buyer. Every 1% increase in interest rates usually diminishes buying power by $100,000. Now, if people are unable to buy the houses at their listed prices or their going price in the market right now, I think slowly but surely the prices that these houses are selling for will start coming down, just because at some point supply and demand have to match at some dollar amount. So if you're in the market to buy a second home, a vacation home, or an investment property, I would suggest thinking about that decision very, very carefully and running those numbers very, very carefully as well. The borrowing costs will continue to go up over the next few years because your interest rates are rising. So it may not be the best time to buy it. Now, of course, if your deal works out, if you really run the numbers and everything is good, that's fine. But I would say take another look at it. If you had run your numbers with a 3, 4, or 5% interest rate in mind, I know that people are getting quoted 6% for investment properties. So definitely take a look at that. Now, I think it gets a little bit more tricky if you're buying a home as your primary residence. See, the option is either you buy the house at the 5, 5.5, 5.25 interest rates that you're getting right now, or you rent a house. But here's the thing, I believe that rents will continue to go up over the next 2 years. The thing is, leases are pretty long, at least 1 year long and sometimes even 2 years long. So whatever rent that you decide or what you agree with your landlord, that gets locked in for the next 1 to 2 years. So over the last 1 year or so, while the costs of home ownership for landlords have gone up, they have not been able to increase rents with pace. And often you cannot increase rents more than 5%, 8%, 10% by city law, and sometimes just because the market doesn't support it, right? But the costs of ownership for these landlords have gone up. Everything is more expensive. Maintenance is more expensive. I believe property taxes will be going up because the property values have gone up. So as your lease comes up for renewal, I would expect that landlords will pass on some of those cost increases to their tenants in the form of rent increases. So that could be an issue that you might face if you decide to rent for a little bit longer to try and ride out the high interest rates. So you should probably think about what the potential new rent would be and then compare that with the potential new mortgage payment would be if you went ahead and bought a house even with the high 5, 6, or 7% interest rate that you might get this year. Now here's something to think about. If you can comfortably afford that mortgage, that monthly payment at this 5, 6, 7% interest rate, you could probably own that home and be fine. As you advance in your career and presumably make more money, paying for that same house will become easier. To add to that, it is quite possible that mortgage rates will go back down in the future, which I do believe will happen 2, 3, 4 years from now. And then you could always refinance at that time to get into a smaller monthly payment and save money at that time. So here's what I think. If you can comfortably afford that monthly payment at today's high interest rates, I still think that owning your primary residence is a good idea in general over renting, so that you get all the financial benefits that come as part and parcel of owning your primary residence. As to exactly how to buy that house, I believe that putting the least amount of down payment that you possibly can is always the best idea. If you're a veteran, you can use a VA loan, which means you don't have to put any money down. Otherwise, you can look into an FHA loan, which means you have to put 3.5% down. And if that doesn't work, you can always go for a conventional loan and put 5% down. With the last one, you would have to pay for PMI or mortgage insurance, which can be worth it. For my case, it was about $100 a month, which I'll be paying for 7 years. So over the next 7 years, I'll pay about $8,400 in PMI insurance. But to me, that's well worth it because I saved 15% in down payment and I can just invest that in the stock market over the next 7 years and definitely come out ahead. Obviously, buying a house in this super hot, highly competitive market with a 5% down payment offer is tough. I get it. I faced the same thing, but in the end, that was exactly the type of offer that I made on the house that I'm currently sitting in. And with that, with increasing rates, I believe that all of these cash offers and these high down payment offers are going to become rarer and rarer as we go into the future. And I think a 5% normal conventional loan will be just fine shortly into the future. I truly believe that using a low down payment is the best way to buy your primary residence. This leaves you with a cash cushion, which can give you peace of mind in these times of economic uncertainty, in these times of very, very high inflation. And also you can use that money to invest in the stock market, to do something else, to buy furniture for your new house. So I definitely think that using a low down payment option is definitely the best option. So that's all I have for you guys in today's video. Don't forget to smash the like button and subscribe to this channel and click the bell icon to be notified instantly when I post a new video. Also go ahead and follow me on Instagram and TikTok at Prashant Kuchi, handles in the description down below. Thank you so much for watching and see you next time.